Now, today's lesson is what I like about today's lesson, honestly. All right, what I like about today's lesson is that it's a 3-point take. Okay, we're going to talk about the importance of curbing expectations. We've been in a very choppy market. Look at HUBC doing exactly what we talked about. We just want to see that bigger volume start to come into it. We've been in a very choppy market as of late. For me, anyways, in January, it was amazing. We had clear-cut direction, good volume, very little chop, and I was having an amazing January. Rolled into February thinking the same, obviously, and that came to a halt right away, the very first week of February, and especially the second week of February. It came to a halt. But those of you who were watching the live stream every single day, you guys probably remember one day in February, right? I said, guys, I'm starting to see signs of possible chop here. And why was that? Well, it was because the SPY was stuck in between the 100-day, the 200-day, the 50-day moving average on the daily chart. And we were just seeing an immense amount of chop in that zone. So we were coming from a month with tons of directional play to a month that started off extremely choppy, right? When you're coming into that, it's like when you're going up a bridge with your car and you get to the top, right? And you're coming down the end here and you don't realize it. Sometimes you try going a little bit quicker because you got that momentum going with you. So we're coming in with that momentum from the prior hot month into what seems to be a colder month. And that momentum can get us in trouble real quick if we don't recognize it. So one of the key things you want to do is be aware of your environment. Be aware of your trading environment in the sense of how is the market acting? How are the setups that I'm trading acting, right? Are they still working the same as they were in January? No? Something's up here, right? So at that point in time, you have to be able to recognize that, and that comes with time. You're not going to do it from one day to the next. You're going to have to be able to recognize that, and then you're going to have to be able to put yourself in a mindset that you're okay with adjusting expectations. This is why I always tell brand new traders, when you go through the course and you finish the course, stay paper trading. Stay going through the course, stay paper trading, keep doing that. You want to put yourself in an environment where you paper trade at least a year, preferably minimum of 6 months, but ideally a whole year, because that exposes you to all these different market environments. While you were trading, maybe paper trading, learning, you might have been in a hot market for the strategy you were trading, and all of a sudden you graduate from that, you go on to real money, and that strategy has cooled down now, or we're in a choppy market, and you start losing money left and right. Why? Because you haven't been exposed to that market condition, so you are unable to recognize it. So you want to make sure that you're able to do that. You want to make sure that you're able to recognize it, and you want to be on the lookout for that. When these cold streaks start to come in, right? It's difficult to recognize, but once you do recognize it, and the only way you're going to recognize it is if you're taking notes, you're paying attention to the market conditions, and you've put in enough time in your trading that you're actually able to pick up on these signals. You have to be willing to decrease something, specifically your expectations. By decreasing your expectations, right, you're going to start to be able to put plans in place. These plans are going to be there to protect you, protect your mental capital, protect the capital in your account, and basically conserve your energies, okay? Because you're going to conserve that capital that you've lost, that you could lose, and you're going to conserve that mental capital. What are ways that we can do this? There are multiple ways we can do this, right? One of the ways that I personally like to do it, depending on what vehicle I am trading, all right, is I'm going to decrease my size. In the futures market, if I really see that I have to decrease a little bit more drastically, then I'll go from trading the ES to trading the MES. That'll allow me to control my downside a little bit more, right? So now I've read and understood that I have to conserve, right? Or curve my expectations. How do I do that? If I'm trading futures, I'm going to possibly go from the ES to the MES, and I'm going to cut my risk, okay, by a certain percentage. It could be a quarter. If I'm going to drop it a quarter, I'm going to stay with the ES. If I'm going to drop it 50% or more, I'm going to go to the MESs for a little bit. If I'm trading equities, it's the same thing. I'm just going to keep trading the equities, right? I'm going to keep trading the stock. I'm going to keep trading the options, but I'm going to decrease my size. Why am I decreasing the size? Because I'm decreasing my risk per trade. My risk per trade ideally always stays roughly the same dollar amount on every trade. On every trade, it's going to stay the same dollar amount on every trade for the most part. Give or take a couple bucks here or there, some slippage or something like that. But in the grand scheme of things, that stays the same. So in order for me to now decrease this risk, I got to decrease the size, but I don't want to decrease it too much, right? I don't want to decrease it too much, because if I have 3 bad trades, right? I take a 4th trade, and I don't mean that in a day, it could be over the course of 2 days. I have 3 full-size red trades, right? If I take my 4th trade with my regular size, that 4th trade really should be able to bring me back to a minimum of break even if it works out fully in my favor. So I don't want to decrease my risk too much when I enter into these segments, right? I want to decrease the risk enough to where I can at least get somewhere near break even on one good trade, right? So you got to curve these expectations and then figure out how to decrease your risk, right, per trade, and what percentage. I don't want to decrease usually more than 50%, right? So if I'm comfortable, let's use some easy numbers. If I'm comfortable risking $300 per trade, then I don't want to decrease my risk any more than 150. I don't want to decrease them any more than 150, okay? So that's what I do. Now, the other part that I like to implement is I get pickier with my setups, meaning I get extra picky, right? If normally I'm trying to trade A and B setups, but the market is so hot and I'm coming from a market where even C setups are freaking amazing, right? And we enter into a slow market, I'm not going to look to trade these C's anymore. I don't want to trade them to begin with. They might escape every once in a while and filter themselves in like little spies, like Chinese spy balloons, but I don't want to trade them. In this other market here that we're in, I really probably even try not to trade the B's. I try to really sit here and wait for those A setups and A plus setups. Why? They're the ones that are going to give me the higher likelihood, right? They're the ones that are going to give me the higher likelihood. Another thing is, if like this week, I had a green day on Monday, okay, a red day on Tuesday, a red day on Wednesday, and these were in my actual account. Then I traded yesterday in my new evaluation account that I'm trying to, get that 200K, 250K account, right? That one, but red. So it was break-even-ish, but with commissions red on Wednesday, red on Tuesday, red yesterday. Today, my sole purpose of coming in here today was to book a green day, to break that cycle. 3 red days in a row is something that it's very rare usually for me to happen, especially coming off the hot streak I was coming off of. Now, I did mitigate my risk fairly well on those red days, right? Because I was coming from trading in my funded account and killing it. And then this week, I gave back a day and a half profit. It's not a big deal. It's really not, but mentally, me anyways, it really messes with me. It irks me. So today's job was coming in and booking a green trade, a green day. I've booked that green day now. I mean, the market didn't give me my final take profit, but I booked my green day. Now I go into the weekend knowing, all right, I broke that nasty red streak. Monday, I'm going to come in, and depending on the action, I'll adjust my size accordingly, never wanting to be an adjustment of more than 50%. And we'll see what next week looks like, right? I might come in onto Monday with kind of the same attitude as today. I'm just looking to book another green day. I'm looking to be a really good spectator. I want to see what this market has in store for us, right? We're going to let the weekend pass, let headlines hit, and see what happens. That's how I approach these colder markets, these choppier markets. It's a lot, and it takes a ton, guys, it takes a ton of discipline. But over the long run, it really helps out tremendously with your capital. And sometimes, even more importantly, that mental capital. All right, guys, I hope you enjoyed that. I hope you got something out of this lesson. If you did, throw me a comment down there in the comment section, and I'll catch you all in the next one.